Hello and welcome to Fidelity Connects. Global trade has been a risk to the markets for most of this year. Through this week, ever more so. The tariff story has been a shock to the system and is beginning to see governments spend differently at home, investing in their own supply chains or with new partners in the global system. Fresh rounds of local stimulus means new opportunities to bolster exposure to global local markets, or at least give parts of the emerging world new reasons to shine. To discuss her approach to the new playing field, we spoke earlier with Fidelity Global Multi-Asset Portfolio Manager, Ayesha Akbar. Welcome, Ayesha. Nice to see you.
Always good to be here, Pamela.
Delighted to have you join us here for this discussion. I wonder if we can begin with a bit of a discussion on, I think most people agree we're sort of past the peak tariff uncertainty. It doesn't mean we know where we're going, but is that fair to begin? Do you take a starting point from that?
I think that's a fair statement. We're all still a little bit scarred by what we saw happen in April when the tariffs were first announced. We saw tariffs sort of increase, decrease, sort of come into a bit of a stasis, and then we had that bit of a hold. Now, clearly, there's going to be things that sort of ramp up again this week, but it does look like we are past peak tariff uncertainty. By that, I mean that, it does look likely that there will be tariffs on most countries. Some of them will be able to negotiate a little bit better with the United States than others. But tariffs do look like they're here to stay. But we do have to see with some quite important parts of the world what is going to happen. Things like Japan, the European Union. And I think the discussions with China are going to be on a separate track altogether.
Now, let's ask you about that. Why on a separate track? Is that actually because decoupling is harder than everyone thought?
Absolutely. I mean, I think if you think about, the difficulties involved in what's been happening, a lot of that does have to do with the fact that you have a lot of economic codependencies between the US and China. There's a lot of things that the US imports from China that can't be done from other places. One of the things that clearly has been in the news quite a lot has been the rare earths. But it's not just that. There's a lot of very specific manufacturing that comes in from China, which can't really be substituted to other countries, or, even though Mr. Trump does seem to want it, that manufacturing can't come back to the United States very, very quickly. So it's going to have to be a little bit slower. It's going to have to be a bit more negotiated. And I think, from a market perspective, that is no bad thing, because that gives everyone involved in markets a little bit more time to adjust to the new environment that we find ourselves in.
And I'd love your comments on the market. I mean, it appears it is adjusting to geopolitical tensions, discussions, obviously trade and tariffs. The market has adjusted. It is climbing so-called walls of worry all over the place. That doesn't mean that there aren't trips and falls and offsets. But what does the reaction in the markets tell you? Is it immunity? How would you term it?
Yeah, it's a good one. I mean, I think we're all adjusting to a world where investors have to be cognizant of what's happening on the geopolitical front. Politics really wasn't a massive issue maybe sort of 10 years ago. It's become a very important part of the toolkit that we have now. But I think what we are starting to realize is that, politicians are really good at telling us what they want to do. They like speaking all the time. But what we really need to focus on is the constraints that stop them from acting out on all of those wishes. So it's really the market constraints that we need to focus on. And when it comes to things like tariffs, for example, it is that economic codependency that we just talked about that is a constraint in terms of how far both parties can go. We also saw the reaction of the bond market earlier during the tariff, escalation. That also seemed to be a little bit of a constraint in terms of what governments could do. So I think markets are starting to realize that there are real constraints in terms of what politicians would like to do, and that is what market participants are focusing on. And if that remains in line, then I think we certainly can climb that wall of worry.
It's interesting. One of the other pieces of the adjustment is that we were sort of mentioning as we introduced you that I think you see that local spending. I mean, even in Canada, there's much discussion about how we rejig local spending. Germany seems to be the example in Europe. This is happening all over the world, though. Government budgets, the fiscal story is being retooled to spend money at home or on new partnerships. Tell us a little bit about how that has affected how you've invested. Maybe we'll sort of go into what Europe's been to the investment story for the last sort of 6 months, first half of the year, and where else you're seeing that. But let's start with Europe and the spending there.
Yeah, I mean, I think this has been one of the most surprising things that's happened so far this year, because I'm pretty sure if you'd ask most investors what would be happening in Europe, the fact that countries like Germany would be turning on the fiscal spend really wouldn't have been up there, as a market event for this year. But nonetheless, here we are. One of the big things that has happened is that commitment from a lot of European countries that they will be spending a lot more on infrastructure, and particularly on defense, and that has really put a lit a fire underneath the markets here in Europe. They've been the best performing markets by some margin. The currency has also had a really good run, especially versus the dollar, and you're starting to see that happen in other places as well. Same here in the UK. You've seen other countries also do that that commitment to spend as well, and I think that's one of the reasons why you've seen that differential, in terms of performance between the US and other parts of the world. The US really has lagged so far this year, even though it's had a little bit of a comeback in the second quarter. But that fiscal spend that we actually had earlier in the US, from successive governments, really the baton seems to have passed from the US to other parts of the world. And that makes, other parts of the world, in my view, certainly a little bit more attractive going forward than the story that we've had for a lot of the recent past, which has been it's all been about the U.S.
It's the U.S. exceptionalism discussion, and people land on that different ways and agree with it or disagree with it. But in terms of, for a long time and still, U.S. fiscal policy was dominant. It is still. There's been lots of spending over the course of past administrations, and now with the big beautiful bill signed, there's going to be more, or at least it's sustained. Where else are you following the fiscal story around the world?
Yeah, so Europe, for sure. There's always the potential for a bit more spend to come through from China. I don't think they will do that just yet, because they are playing the long game here and waiting to see what the U.S. does before they really let that big fiscal spend come through. But also remember, there is another factor here that we have to look at, and that is really the revenues that are coming through from tariffs. That's been pretty impressive. And if you think about sort of, the fiscal spend as being part of a fiscal impulse, what you're having is actually two effects. So yes, the beautiful bill will increase spending, but you're also getting tariff revenues, which actually is going to reduce that fiscal impulse. So it may not be quite as successful, certainly towards the end of this year, as fiscal spending has been in the U.S. in the past. So again, that focus on the U.S. that might start to shift to other areas where the government spending is going to be more meaningful, because there's not going to be any offsets from tariff revenues.
That's so interesting. So the impact of fiscal spending might be more impactful elsewhere. Europe, you mentioned,
absolutely,
is one.
Yeah.
This sort of takes you to what you said about China and maybe EM more broadly as well. Are you looking at EM more broadly?
We like EM. We like EM assets quite a lot at this time, both equities and debt, and especially on the debt side in local currency. And there's a number of reasons for that, even though it can seem a little bit counterintuitive. The first thing is that dollar depreciation is pretty good for EM assets. They tend to do well when the dollar is going down. Inflation is relatively low. That tends to be something that helps quite a lot. Emerging market central banks have been very orthodox. They have been reacting to market environments, and they're actually in a position where they can, from a monetary perspective, sort of reduce rates. And we've seen that in a number of places already. As long as China remains okay, emerging markets tend to be in a pretty good place at the moment. So we like emerging market assets quite a bit. I think there's a lot of opportunities within certain countries and certain areas, but overall, where we've been, taking profits from our developed market exposure, we've been adding it to emerging markets.
It's so interesting that you talk about the debt markets and with local currencies themselves. Again, with the US dollar being what it is, we've seen all kinds of currencies strengthen in their own ways. Just tell us a little bit more about the monetary story. Is there a broad story to tell beyond? So they've been quite orthodox central banks. I mean, that's interesting and new, is it not?
It is a little bit of a change. I mean, and I think this is a new environment that we find ourselves in, where a lot of relationships, a lot of things that happened in the past are changing. So you've had emerging markets, which actually since COVID have been very, very orthodox. You didn't have a massive amount of fiscal spend to deal with the pandemic, and you've had very prudent policies on that side. And clearly on the other side, we've in developed markets, you've had an awful lot of spend, which is kind of one of the reasons why we're all quite focused on what's happening on the deficits, especially in the US, in terms of what happens and what moves markets going forward.
Yeah, that's absolutely fascinating. Let's take a look at India. India and China are have been these massive, enormous economies within the global economy. What does this moment with the US making shifts, making changes, how are they working that to their advantage? And then maybe we'll talk about each of them separately. But
Yeah, so I mean, obviously the big story in recent years has been China. That relationship with the U.S. is changing. China has gone from really becoming the manufacturing powerhouse, of the world, and what they have done is really move up that manufacturing, universe quite a lot. So you're not doing the low level stuff now. This is getting a lot more high-end exposure to manufacturing. Clearly that there is a limit to how much that can go. Certainly, the U.S. administration is not that keen that China remains a manufacturing center. They want manufacturing to come back, and they want other countries to step up as well. So a lot of market participants have been looking at what could potentially replace China as that big growth engine that we've seen. And, it is natural that you would be looking at India as something that could do this, big population, educated population, some really world-class, tech and finance companies. So the hope is that, India can step up and really be that manufacturing base. I think that's a little bit way off. We still have more to do, and it's actually one of the reasons that India hasn't necessarily done that well this year, because a lot of other countries, especially in Asia, have benefited from that bringing forward of manufacturing and exports. India doesn't have that yet, so it hasn't really benefited. But the flip side to that is that the great companies that India has really means that it tends to be quite expensive. That has come off a little bit this year. India has underperformed. It hasn't done as well. The macro environment hasn't been as good, but you can see that changing going forward. So it does look like a GDP is going to be good. If we get a decent monsoon, which seems to be on track, that is generally a good sign for the rural economy and for consumption. The RBI, the central bank in India, is starting to cut rates, which also should be supportive. So India does look like this could be a good opportunity to get back in. It's got some great companies, but is it going to be the replacement for China? I think the jury is still out on that for the time being. So we tend to let our active managers decide which is the best place to invest in India at this time.
right, yeah, much more idiosyncratic in that sense. Well, just to be not idiosyncratic for a second, there's much discussion has been throughout this week and sort of recent weeks about the BRICS as a group and what they can do, again, sort of on the world stage at this moment. I'm curious whether you think there is anything meaningful for investors out of this discussion right now. Maybe there is, maybe there isn't, but it certainly creates good headlines.
Yeah, I mean, BRICS is an interesting acronym, right? So this was supposed to be the group of countries that was really going to drive everything forward, but they don't necessarily have a lot in common. You've got Brazil, which is a great commodity producer. You've had India, which really doesn't produce anything, and in fact imports 90% of its energy requirements. You've got China, you've got Russia. So it was a nice idea, but it is a bit of a hodgepodge of countries that come together. But I think one of the reasons it's been in the news recently is that we really are at this time of sort of in a bit of flux. We've had an order that's been led by certain countries, and that is going to change. And BRICS potentially is one way to do that. Now, one of the things that clearly has come up when it comes to BRICS is an alternative to the US dollar, which is something that really has been something that market participants have been talking about. Can that dollar remain that reserve currency, which has really benefited the US for such a long time? I think the jury's still out. We don't necessarily see a huge shift towards that becoming a rival in any sense, but I think it is indicative of what markets are worried about. Something to watch, but not necessarily something that we're too concerned about at the time being.
Okay, and it doesn't necessarily drive your investment decisions at this stage as a sort of as a conglomerate. No. Okay. Yeah. So let's have a minute on, or longer than that, on positioning. So based on a number of the things that you've talked about, and whether we do or don't like the term U.S. exceptionalism versus something else, how are you invested?
Yeah, so as a multi-asset investor, we're looking at sort of equities, bonds, cash. So at the top level, really what we're concerned about is what's happening on growth and what's happening on inflation. Now, I think we're sort of a lot more confident that actually global growth is okay for now. We've had the tariff uncertainty, but actually the numbers aren't looking too bad. And when we're talking about that, we're looking at the U.S. in particular. There are pockets, small indicators that show that probably the economy is going to start to slow from here, but nothing that's showing a precipitous fall off. So growth picture looks okay. And that generally means we want to be sort of a bit more risk on. So we like equities a lot more than we like bonds at the moment. And that bond picture is kind of determined by two things. So one is clearly inflation. That the jury's still out a little bit on that. Again, looking at it from the U.S. in particular, not too many signs that inflation is picking up, and that was one of the worries with the imposition of tariffs. But it's not necessarily showing up just yet. So Chair Powell, we're kind of holding our powder dry on that. But the other issue that's really making it a little bit more difficult to decide whether you want to be overweight bonds at the moment is what's happening on the U.S. deficit. That really has been a concern. We've seen yields move around quite sharply in both directions over the course of the year. But we're holding back on our U.S. Treasury positions. We're a little bit keener on other parts of the world, and as we talked about earlier, we really like emerging market debt. We think that looks like a good place to be at the moment. So we prefer equity to bonds. We're as ever, it's going to be data dependent. So we're really looking at the hard data in the U.S. Very closely to get some indications of what might happen.
Part of the, being overweight to the U.S. and the U.S. exceptionalism story, I mean, a piece of it obviously has been the technology prowess of the companies within the U.S. Is it hard to pivot away from that? I mean, why would you? It's amazing. They're amazing companies. They do incredible things. Just talk about sort of the stickiness of that for you, one way or the other.
Yeah, so again, that U.S. exceptionalism story, as you said, has been driven a lot by the tech companies. And actually, that was one of the other concerns that markets had at the start of the year, because, it seems like a long time ago, but we had that whole DeepSeek episode, at the start of the year, which again was an indication of really how far China and Chinese companies have come in terms of their development and their ability to really sort of challenge the market leaders. But if you look at what U.S. tech companies are doing, and we're becoming a little bit more nuanced in terms of what are tech companies, the spend is still there, the earnings are still looking pretty solid. So if the U.S. is going to do well, it is going to be driven by these companies. They had a little bit of a pullback, so we used that opportunity to add back to our U.S. tech positions. So we're neutral on the U.S. overall, but we do like the tech companies still. We think those ones could potentially still be still drive things forward.
I think you have said before, if you take the view that China, their economy, the way they've, for instance, kind of ring-fenced the real estate story, which still plays out, but it's sort of not a loud story at this stage. We've also got a proliferation, really, of cheap oil, cheap gas. OPEC makes sure of it, but the U.S. is also energy independent if it wants to be. Large swaths of the world are kind of figuring out a new energy picture in a lot of different ways. Just from that perspective, a cheap energy source and other ones being added to it, and the fact that China seems to be powering forward, again, because you look at things from such a global perspective, what do those two components mean for, I think stability is probably the question.
Yeah, it's a good question. I think the energy question is a pretty good one, right? Because you can't really be a economic powerhouse until you have the energy to quite literally power the economy. And I think that's been the other thing that's really happened so far this year. So one of the reasons the U.S. has been exceptional has been because of shale. They've got their own source of energy. And I think one of the things that China realized is that they didn't really want to be dependent on too many other countries, in interest to sort of more sort of volatile parts of the world for their energy needs. And it's one of the reasons they've kind of gone really a twofold approach. One is to use their coal, but also to go down the renewable energy sector, which is now certainly in solar they are the leaders. So both countries really have been focused on making sure that they don't get disrupted by a lack of energy and a lack of supply from that perspective. And I think that's actually one of the reasons why all the events, unfortunate events we've seen in places like the Middle East really haven't caused that much disruption in markets, because they're not really affecting the two big economic countries that drive markets at the moment.
It's fascinating because you also see, do you see a more broad, I don't know if it's copying that type of model from China, but the idea that there's sort of a dual track, a traditional energy, maybe not coal, but maybe heavy oil, and also branching out into a more renewable energy, sort of just to get things moving and running. And as you say, maybe less dependency on certain parts of the world that can be volatile. Like a lot of countries are looking at things that way, are they not?
Absolutely. A lot of countries in emerging markets are going down exactly that route. So, very much taking advantage of cheap solar from China, using their own resources as well where they can. So I think, that is a good story to some extent in terms of countries being able to move ahead without having that worry. And again, that's a good story for emerging markets, because a lot of their deficits were to do with importing energy. If that goes down, and certainly oil prices have come down, even though we've had a bit of a rise, given recent tensions. That's another really good reason to be positive on emerging markets, because their fiscal situation is going to start to look a lot better because of the cheapness of energy prices that we have at the moment.
What are some of the most interesting areas within emerging markets that we haven't spoken about? So we've spoken about India, China, Vietnam, obviously very linked to sort of the connective tissue of the global trade story, and it has its own tariff story and deal and so on. But I'm quite curious where you are enjoying taking a look at assets, which part of the world?
Yeah. So there's a lot of good places to invest in Asia at the moment. So one of the places that we're pretty keen on in multi-asset at the moment is Korea. So Korea had its own issues at the start of the year. They had their political crisis. That's really come back, and that exposure to exports, to defense, to tech companies has meant that it has come back quite a lot. We still think there's a little bit more to go from that perspective. So countries like Korea, there's other sort of more niche ideas. We think Brazil could be potentially quite interesting as well, given everything that's happening there. So, quite a lot of very, very interesting alpha plays, as we would say, within the emerging market complex. And I think, more broadly, that might be a theme for this year, that, given the volatility that we've all been seeing, it may not be, a year to be sort of absolutely full on risk or anything, but I think there's enough alpha opportunities from a country perspective, from a sector perspective, that could return some really, really nice returns for our investors, within our portfolios this year.
Maybe I'll just finish out. The UK has a trade deal with the United States. There are other ones circling. We have new dates, things being moved to August, all these headlines that have been around. What does that represent? You're in the UK. How does it work for the economy there?
Yeah, well, I think we're all pretty glad that we're not necessarily in the limelight over here. But I think for us, it just means that there's one less thing to focus on. So it's not the external side of things that we necessarily need to worry about, but there are certain things within the UK, from a fiscal deficit point of view, from a spending point of view, from a supporting the economy that we are starting to look at. So it's one of the reasons why we think UK gilts, for example, could be a pretty good place to be. But also on the other hand, the UK equity market is looking particularly cheap. So it's been that way for a while, but potentially represents some good value. So looking for a little bit of support from government budgets going forward, but gilts look good, and we're pretty keen on equities, hopefully with a little bit of a stimulus coming through later.
It's a delight to see you and to hear your incredible thoughts and strategies. Thank you for sharing some of your time with us, Ayesha Akbar from London.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.